Good morning, good afternoon, good evening, wherever and whenever you are watching this podcast. Thank you for being back and joining us. Obviously, you know myself, Matt Cormiller, and Michael Seatner. A new face to the screen, Jenny Daly. I'm going to introduce Jenny here in just a moment. But before we get to Jenny and the capital markets team, I thought I'd just give a brief update of where we are. So we are now March 19th. We are over a full year into lockdown, which I think when Mike and I started doing this, we were 2 months into lockdown. And we figured we'd be back in the office in a month. So don't help us with the predictions game. With that said, we are starting to see vaccines slowly roll out here in Ontario. On a personal level, very happy to report I have 3 grandparents, all in their 80s, all got their jabs within the last 2 weeks, which has really helped with my stress in this whole process. So that's a positive. And I think we're seeing it on our client side now that vaccines are starting to roll out and now that people are having confidence that we're going to all be vaccinated, whether it's this summer or this fall. People are starting to talk about their office.
That's an interesting point, Matt. It's like with our clients are going through this process. Is just on a side note on kind of the leasing market is we're so busy right now. I know our team is, Matt. I know your team is. There's a leading indicator on people coming back to the office. It's how busy brokers are right now, helping our companies plan for 6 and 12 months from now.
Yeah, and what we thought we would do today, and I think that's a really good segue, Mike. So I thought what we would do today is bring in Jenny Daly. So I'll let Jenny introduce herself and their team, but Jenny works within our capital markets team, which is really the acquisitions and dispositions of assets across Canada, really, right, Jenny? All assets all across Canada.
Right. Yeah. Our team spans the country. Obviously, my team is focused here in the GTA, led by Matt Pickin and Bryce Gibson and myself. So yeah, we've been pretty active. We're certainly seeing that pick up as well at the moment. So it's good to see. Yeah. I mean, we've been very slow on the vaccine rollout and it's picking up pace now, which is great, you know.
Yeah. So maybe Jenny, just for a little bit of background before we dive into the conversation. So maybe we'll focus today, obviously, on the office sector. That's what Mike and I focus on. That's what most of the people that listen are interested in from a tenant or a user point of view. But maybe we could just start. So going into the pandemic, I think the capital markets world, everything was trading. There was buyers, there was sellers, record pricing, I think, on every single deal that you completed over a 2 or 3 year period.
Right.
Then the pandemic hit. And now we're 1 year into the pandemic. So maybe you could just give us a little 3-stage where we were going into the pandemic, what those first kind of 6 months looked like after, and maybe where we are today and where you think we're going over the next year.
Right. Yeah. Obviously, the market was, very strong. The downtown office market, was extremely tight going into this pandemic, which is obviously going to help later on with the recovery. Yeah. But, when March hit in last year, it was interesting. I was sitting here in the office. I remember it was that Friday, the 13th, and we were just herded out of the office. And, it was a moment of panic, I think, for us and for a lot of people. And, it was a new normal that we all had to adjust to. And everything just went on a pause. I think, for us, certainly, we had a pipeline of mandates to bring to market. And I think, all of our clients sort of, took a step back and reassessed and really didn't want to or didn't see it as the right time to launch, really anything to the market till we, till things settled down just a little bit and we saw where we were. But I think that pause kind of continued for, it was several months.
It was longer than a pause.
Right. It was longer than a short pause. Absolutely. And I think it's really only now. I mean, there was very little, certainly in the way of office, there was very little brought to market in the course of the past 12 months. And it's really only now that we're starting to see some assets trade. We've been active in the market. There's been a couple of other deals transacted. And so that's interesting to see now.
That's good.
We're in a bigger picture before we dive into office. So in terms of when activity picked up and what it picked up with, kind of buying and selling of assets, what were those assets looking like, and when did they start to trade over the past couple of months?
Well, it's obviously different because the different asset types and the market has performed very differently for each of them. Like, for instance, over the past year, I think over the past 12 months, investment volumes generally were down about 20%. but that's not, across, it felt evenly across all the different asset classes. For instance, multifamily had a huge record level of trades, and land certainly traded very heavily, but office, retail was way down. Industrial was down as well because that's the darling, and I guess a lot of the owners felt that they wanted to hold on to that product.
I see. So that's an interesting dynamic. So multifamily obviously makes sense how that market would be on fire. If everyone assumes people are working from home, there'd be more demand for space to live and owning those assets. That's an interesting one. I hear what you say about the market being so hot and desire for landlords to hold on to it. And office, it sounds like was basically dead over the past 12 months or so in terms of trades.
Right. Yeah. I mean, there was one significant trade in Markham that was sort of done late last year and closed early this year. That was sort of a test of the market. Was Northern brought out two buildings in Commerce Valley Drive. And so, there were all eyes on that trade at the time. And then in the downtown core, there have been a couple of, partial interest transactions, partial interest sales, 50%, right here in the core. And that's interesting. I mean, I'm certainly long in office, right? I've got 3 young kids. I'm very eager to get back to.
You're in the office right now, it looks like.
I'm in the office right now for that reason. But I like to spend my time here. I like the separation. It works well. I think for the most part, I mean, people are over it, right? Like the working from home, it's novelty, it's worn off. So it's
Well, it's fun. I'm just on that point, Jenny. It's funny. So I remember when the first 3 months of lockdown, the stats started coming out. Everybody loved working from home. Never want to go back. We love working from home. And then over that kind of 6 to 9 month mark, it was okay. I could see why we would be back to the office. And now, I think the most recent stat I saw, we're a year into this. 88% of the people want to be back in the office.
Totally.
Now, it doesn't mean 88% of the people want to be back in Monday to Friday, 9 to 5. But 88% of the people, and I think that number is only going to climb, are saying, okay, I get it now. I understand why we had an office. Like I think about us, our office leasing team and your team on a capital markets point of view. I mean, we're fortunate enough to work together on quite a few files, which has been fantastic over the last 5+ years. Mm-hmm. But it's more than that too, right? It's just, it's popping over and tapping on the shoulder and asking a question. Like, I don't think people realize this. When we're working on leases, we'll actually go to the capital markets team, or Jenny specifically, tap her on the shoulder and say, hey, Jenny, here's the value we're adding to this asset. Do you think there's an opportunity here for the seller to potentially sell within the next 12 months, and we can actually negotiate it a little bit lower because it's going to come to market? Like, I think there's a real synergy between our two teams, because ultimately your value on an asset is really the income. Is that kind of how our listeners should be looking at it?
Yeah, absolutely. I agree. It's tough. We're used to seeing each other a lot more often. Yeah. And it is so nice to be able to walk over and equally when we're valuing an asset, we're going to you guys and we're saying, what do we see is the future for this market? What do we think rental growth looks like? What is the vacancy projection? And we're getting that very valuable input from you guys that helps us with our underwriting, which ultimately feeds into value. So, obviously that's very much an area of focus right now for everyone. And it's something that we're spending a lot of our time on, and I think everyone's trying to get their head around that right now in terms of, the investors as well. Yeah. As we've been, we're active with a suburban office opportunity right now in the ACC. And as we're talking to our investor clients, I think they're trying to get their head around, maybe they're not necessarily going to pursue this opportunity, although there's been very good interest in it. But, they want to understand it. They want to see, well, how have you looked at it? What is your projection? And they want to sort of come to the conclusion themselves as to where they stand for this suburban office opportunity and suburban office in general.
I'm guessing a lot of those assumptions, and when you value buildings, it's what is the probability of renewal? And what's the size they're going to renew at? And all of a sudden now that question mark is thrown in the air where our company's going to downsize or vacate when those leases come, where in the past you might have put a pretty high probability on that company renewing in place.
Absolutely. Yeah, and that's definitely a factor. I mean, it's all about the tenant roster. We're very focused on that right now. So when we're looking at an opportunity, we're looking at the tenant roster and we're saying, how insulated is this against COVID impacts? And obviously, if you've a travel company, they're obviously really suffering. I think if they can get through the next few months, they'll be very busy thereafter. But yeah, I mean, we're very focused on that.
Well, it's funny, Jenny, like covenant's always part of the conversation when we're looking at leases or working on behalf of clients. I would say covenant's almost the number one question either landlords or sub-landlords are asking right now. Well, what's the covenant of your client? If you're coming into the space for the next 10 years, basically, are they pandemic proof? Or are they proof of the next fallout, right? Like this is now part of the conversation that we're having across the board. So when we talk about, I know there's a few opportunities in the market right now, not as many as you would normally see in Q1 of a calendar year. Who does the buyer pool change? Has the buyer pool changed? I know in Toronto, maybe you can just break down. We have institutions, which are much different in terms of how they look at buildings and the pension funds compared to privates.
Yes.
Is there more of a market for privates to hop in? Is it institution dominated right now? Where are we at?
Well, that's very interesting that you bring that up. We've looked at, the profile of buyers over the last few years. And, in general, the privates, I think since 2017, they sort of doubled in terms of their representation of the market, the market volume that's been trading. There's way more representation from private buyers. And so, it's interesting. I mean, they used to play in very much, the 5 to 20 million range. Now we're seeing those well-capitalized private groups who have a strong preference towards bricks and mortar investments in real estate in general. But, they're certainly playing in the 100 million plus range now and competing with those institutions. But they're maybe a bit more nimble in that, they don't have investment committee approval. They don't have the same criteria or boxes to check in terms of, moving forward with an opportunity. So they're certainly very competitive. And we've seen a lot of that. And one of the most recent high profile trades was to Sunil, who has become a major player and a major investor on the private side.
Yeah, and I think
are they putting up bigger numbers?
Oh. Sorry, say again?
I was going to say, are they putting up bigger numbers? Like, are private guys more aggressive in terms of offering? Are they winning these bids, or are they just in the mix?
Yeah, well, I mean, by virtue of them, representing a larger portion of the overall investment volume, yeah, they're being more successful. And I think, they're certainly competitive. I mean, I don't think they're overpaying. But they're able to sort of, as I said, maybe be more nimble and a little bit more flexible than maybe some of the institutional players.
Well, I would imagine they have more flexibility in their pro forma as well. Just to really, if they have to stretch slightly, I think they have more of an opportunity to stretch slightly.
You're right, and their underwriting is not as conservative potentially.
That's probably a good way to put it. Well, I think even Bay Adelaide North. It's a private as well, which is one of the bigger ones on record over the last little while, at least downtown.
Dadco, yeah, that obviously the same group that moved forward on the earlier transaction at Bay Adelaide.
Well, it's funny, but and this is what we're saying when we're talking about merging the capital markets and the tenant rep team and why we work so well together. When the first Bay Adelaide transaction was completed, I think that was a 3 cap, a 4 cap. It was incredibly low. And rents at the time in the building were $35 to $40, right? By the time we hit lockdown, there was up to $50 a square foot. So what does that 3 or 4 cap look like now that we're at a $50 a square foot number, right? It starts to look really good. And I think what we're trying to do with our tenant clients right now is, and why this has been so important over the last year particularly, is I don't think the tenant client necessarily understood or was in tuned enough into what value they bring to the building. Besides just, hey, it's a great opportunity for us, which is always the number one focus. Hey, this is where I'm going to house my employees for the next 5, 7, 10 years. And we've really found out over the last year just how important that decision is. But from a negotiating point of view, it's also the value for these assets. That's how the landlords eventually make their money and then ultimately sell, is based on that income. So I think it's part of the conversation we're having more now, which is not only am I focused on my people first and foremost, but when I'm actually looking at a transaction, maybe there is a benefit for looking at one building over another because of the ownership, or because we think we can get a better deal because it's going to trade. And it's another, tool in our tool belt, right, Mike, in terms of negotiating against landlords, quite frankly.
Yeah, if you're a big tenant in a building and you know you're a big part of that value from where your leases and how many floors you take up, or what percentage of that asset, you have negotiating leverage. And that's negotiating leverage, not 12 months in advance of your lease, that's 24 months. That's up to, we're working on deals right now that are 4 or 5 years out, that
Right.
and the tenant are working together to try to find a way to keep them in the building long term, providing some benefit for the tenant today and improving the landlord's building valuation long term.
So
Yeah, and just to jump in on that, I would agree on that longer term. Obviously, we're coming from the landlord side, but where we've seen investors look at tenant roll, and in prior years maybe they were concerned about a major tenant rolling in the next year to 2 years. Now they want to know, have you had those discussions with that tenant who's renewing, who has a termination 3 years out?
Right. Well, and that's probably the biggest difference now between where we were and where you were in 2018 and 19. If you had a big tenant roll in 2018 and 19, I think the more astute landlords were actually hopeful they wouldn't renew, because the new market rate of a tenant coming in was going to be much higher than the renewal rate potentially of a client that had been there for 15 years and was just going to outdated space. Where the astute landlords out there, the nimble groups call them, were able to actually go in and say, no, if I put in a little bit of money, I can really increase the value with the rental rate. Now, it'll be interesting to see where we come back at that, because I don't think we've seen that over the last year. I think everyone knows what the markets look like over the last year. But, Jenny, let's look out the next 12 months, 24 months. At some point, do you think the dam's going to break and everything's going to hit the market? Do you think it's going to be a slow trickle over the next 12 months? Or do you think it's once these first 3 or 4 office trades happen, we're off to the races?
Yeah, and on that, one more point, who's putting their space on the market right now and why? What's motivating them to do it today versus wait a year?
Yeah, so I think, we talked about that pause, and there really wasn't anything in the market. So, when it comes to making the decision to sell, you sort of need some kind of benchmark as to, what's the value of my asset right now. In the absence of trades, you don't have that. So now we're starting to see a bit more transaction volume, a bit more activity. You sort of have those benchmarks in place, and you can make the appropriate decisions of whether you can hit your desired returns or not. And so, we're starting to see a bit more of the institutions bring assets to market now, because there's just that little bit of pickup. There's a bit more positivity. Obviously, it's heavily correlated with what we think the pickup and the overall economy is, and where vaccinations are at. And so there's definitely investors that are long on office. I think in general people are, but it's, what does that recovery look like? Is it, am I recovering over a year, or is it 2 years, or is it 3 years before I'm fully stabilized? And that's a perception, and that's each group are sort of working through those decisions right now as to where that's at. And obviously that has an impact on value.
That's interesting. And I imagine on the flip side of that, though, the buy side, I imagine there's money that's been sitting on the sideline for the last year that wants to get out the door.
100%. Yeah. I mean, there's, we refer to it a lot. There's a lot of quote unquote dry powder out there. Absolutely. There are groups that are paid to put money out. Right. Investors that, maybe, had a little bit of concerns around the equity markets, have a preference towards real estate and hard assets like that, and just haven't had the opportunities. And so yeah, there's certainly eager to put money out where it makes sense.
To Mike's question, right? Nobody likes to be first in these scenarios because you don't know what the top of the market is or the bottom of the market. But those first couple assets are going to see more buyers than I think they ever would have seen. Like when you talk about the activity levels out there, there's money that sat on the sideline now. People want to get money out the door generally. We know lenders are at all-time lows and they want to get their money out the door. So I think there is appetite to buy again. It's just, what does that look like? Where's that, the dartboard? How do we get it right in the bullseye, right? So,
and on that, so what a question I'm curious about is, in terms of valuation, what's been the impact? have cap rates gone down? Have cap rates gone up because they assume that the income of the property is going down and you still have a lot of money in the market bidding? Like how has valuation specifically been impacted in this market?
Yeah, I mean, in our experience, we've had a couple of assets in the market, obviously, and let's talk about office just in particular. We're not seeing a big adjustment. There is certainly, I don't think we're hitting the peak pricing, but there's a couple of factors. Obviously, it's that what we spoke about previously. It was what's the recovery like. So if you think it's quite immediate and quite rapid, that's going to drive your valuation a bit higher. If you think it's going to take you 2-3 years, that's going to impact what you're going to pay. And the bond yields have crept up over the last, since last September quite substantially. So the financing is got a little bit more expensive, although spreads have come in. It is available, but obviously that has an impact as well on your levered returns. So what I would say is on the office side, I'd say we're seeing a marginal adjustment, but nothing that big discount for sure.
I mean, these two things go hand in hand. We're not seeing a huge discount on net rents right now. Right. Like if you actually look at what the net rents have done over the last year, we haven't seen a huge dip. I think people thought out the gate, well, great, we're just going to reduce our rent by 75% and we're off to the races. We are seeing it adjusted on an inducement point of view. But when you're looking at it on your side, it's really the income. I mean, the inducement's paid out. That's done. That's money off the table. It's the income you're selling. So I think those two things go hand in hand. I don't think that should be a surprise to people to hear we're actually not seeing pricing dip too far because we haven't seen net rents come off too far. So anyways, I know we're tight on time here because all of our teams are busy right now, which is really encouraging to hear. So Mike, I don't know if you have any last questions. I really enjoyed this conversation with you today, Jenny. This was, I think, both insightful always for us. One, it's just great to see you. I miss seeing you in the office. And, it is nice just to see each other. But I think for our listeners, it is really it's a different point of view, but of the same, the same landscape. I think we look at things similarly. We're representing the same groups, we're talking with the same groups. And I think that interaction, to your earlier point, the reason I'm missing the office, collaboration it's not a scheduled event. Right. Like we bump into each other, we talk to each other, and that's one of the things we all miss. And I think our clients miss that with their people too. So I think we are seeing people get back to the office. It's encouraging. That'll help our business. That'll help your business. It'll help the economy in general. So maybe we'll wrap it there. I don't know if there's any last things you want to add, Jenny.
No, I just want to say thanks so much for having me. It was great to join you guys.
Of course.
Yeah, appreciate you coming on.
Awesome. Well, thanks so much, everyone. We'll stay safe out there and we'll all talk soon.
Okay, bye.